There have been some very interesting things happening in the bond market recently. Interest rates have been slowly going up. Now, obviously, you know that if you have a higher interest rate on your car loan, your monthly payments will be higher, all else equal. If you have a higher interest rate on your mortgage, your monthly payments will be higher, all else equal. If you have a higher interest rate on your credit card, your minimum monthly payment will be higher, all else equal. But companies borrow money a little differently than how consumers borrow money. When they borrow money, they don't go to the bank and get a loan. They sell a bond. And they sell a bond on the bond market, which means whoever wants to buy it can buy the bond. Now, what is a bond? A bond is essentially an IOU. Let's say a company wants to borrow $10 million. So they sell a $10 million bond. And the buyer of the bond, the IOU, pays the company $10 million. And for the term of the bond, 1 year, 3 years, 5 years, the company pays the bond holder the interest every month for the period of the bond. So let's say the bond is a $10 million bond. And the interest rate is 10% per year, or $1 million per year, and the bond is a 1-year bond. They take that $1 million, the interest rate for 1 year, and divide it by 12, and they pay that much each month. And at the end of the 1 year, at the end of the bond term, they give back the $10 million. That's how the bond market works. If it's a 5-year loan or a 10-year bond, it's the same thing. It's just spread out over 5 years or 10 years. Now, what is interesting is that over the past 20, 30 years, interest rates have been slowly decreasing. This is a great bond market. When the bond prices go up, interest rates go down, and this has been happening over the past 20, 30 years. So what does this mean for businesses when they want to sell a bond into an economy with consistently and slowly decreasing interest rates? Well, let's say it's year number 1, and the company sells a $10 million bond at 10%. They pay the interest every month, and let's say it's a 1-year bond. At the end of the year, they have to pay back the $10 million. But let's say it's a year later, and interest is now 9%. It's cheaper. Well, they can borrow another $10 million to pay off the first $10 million. But because the interest is cheaper now, they can borrow a little bit more and have the same monthly payments. And let's say it's a year later. Interest is now 8%. They can borrow a little bit more, pay off the previous year, and have the same monthly payments. And companies have been doing this for the past 10, 20 years, which means right now they have a fuck ton of debt, which is okay so long as you know that next year interest rates will be lower than this year, so I can just roll my debt over, and because interest rates are lower, I can borrow a little bit more and have the same payments. But now as companies are looking forward, they're saying interest rates might be going up. So if you have a fuck ton of debt that you need to roll over every year, and you're looking ahead and you're seeing higher interest rates, you're thinking, holy shit, our operating costs are going to be going up consistently over the next several years if interest rates start to go up, and they keep going up. That means they need to save costs, or they need to raise prices, because they need to offset the increase in payments they'll need to be making on their interest rates. And they can only do this 2 ways: cut costs and raise prices. And they cut costs by laying people off, and they raise prices by making everything more expensive. That's why companies like Netflix and Amazon are raising their prices now, because they're looking ahead and they're thinking, holy fucking shit, the interest rates are going to go up, which means we're going to have a lot more expensive operating costs. So because so many companies have a shit ton of debt today, and they're shitting their pants because they're afraid interest rates are going to go up and make it harder for them to do business, they're putting pressure on the government to lower interest rates. The problem with lowering interest rates is every time you lower interest rates, it makes it cheaper to borrow money, more people borrow money, and that creates new money. And when you create new money, you expand the money supply. And when you expand the money supply, that can cause inflation. So that's kind of the predicament everybody's in right now because of the past 20, 30 years of all this easy money. Now people have got to pay for it. And they have to pay for it by being between a rock and a hard place. Interest rates go up, companies lay people off, raise prices. That can cause a recession. Interest rates go down, new money in the money supply, increasing money supply, that increases inflation. So these are 2 very, very likely potential outcomes going forward. Either a recession because companies have to raise prices and lay people off, or more inflation, which fucks everybody. So what do you do, dear viewer, looking forward to this potentially train wreck economy? Well, in a world of social media morons and everybody copying and pasting from AI, you can clean up if you develop some very, very powerful face-to-face persuasion skills. In a world where nobody can talk their way out of a paper bag, when everybody is brainlessly copying and pasting from ChatGPT on their resumes and at their jobs, if you can develop some face-to-face conversational skills, if you can develop some face-to-face persuasion skills, that can be your golden ticket. And the good news is, to develop these face-to-face persuasion skills, you just need to practice persuasive language. You don't need a STEM degree. You don't need an MBA. You don't need to be a superstar salesperson. You just need to make a daily habit, to make a decision, to start a daily habit, to practice persuasive techniques. If you want to learn how, check out the links below. Thanks for watching. Please like, subscribe, and comment, and I'll see you next time.